like, I don't need to get a yield on what I own because the capital appreciation of my house is going to go up 20% a year.
Right.
We're going to have to go back to like, what am I getting paid for to wait here?
Mm-hmm.
Right. And Mike, I don't know if you remember, I can't remember what the absolute number was, but you mentioned 1966 to 82, Jeff, as being kind of like a flattish and zero returning price value for the Dow, right? So for that 16-year period, you made no money on price. And then for the following 16 years to 1997, you annualized at 16%. Okay?
Yeah.
Now, that was the financial markets doing that. But the earnings rate was nearly identical for both periods, right? So that you don't need, and I can't remember what the absolute number was, but the point stands, right? We as portfolio managers, we have to disaggregate what the economy is doing and what the growth rate is doing. So maybe we are at a growth rate, maybe the analysts are all right, and maybe we're on trend. But the multiple is what's going to matter for financial markets, and that's what's going to matter for your portfolio. Right. And there's going to be areas that are going to go from their highs to very, very lows. They've already happened, as you said, in the NASDAQ, right? A lot of companies there down 70%, probably won't recover for a while. And there's going to be areas and sectors that are going to matter, that own real things and have utility and pay dividends and are tangible and can push forward their inflation costs and so on. So this is kind of where we're talking about a market, a financial market that is currently talking about the S&P 500 index continues to be dominated by high-flying, no-yielding assets, where the small percentage of the S&P is real things, right? Yeah. I mean, I think commodities are what, 2% of the index right now?
Yeah, it's
right.
smaller.
So we're going to need. This is where active management, I think, starts coming in. If the S&P is going to flatline for a prolonged period of time financially, even though earnings are going up, where do you want to rotate your portfolio toward? And I think you're right, Jeff. Yeah. If that's going to happen, value players seem to have a better grasp at earning some yield.
So
Jeff, I
posted a Twitter storm on that the Q4 of last year, just on the earnings growth through that period and how it was the same. The difference was the initial conditions. The initial conditions were a high multiple in 1968, right, on those earnings. What happened is the earnings grew, but you went from a multiple of 16 to a multiple of like 6 in 1982. You have to go look back at that. And this is a critical point, I think, to understand, and something that asset returns when rates are rising are much lower. So your equity risk premium on equities is normally 6%. Well, when rates are rising, it's 0. So, and this was covered in the DIMSM report that the Credit Suisse re-ups every year, and they talk about it. So they put it up in February, and they show these charts. Listen, when you have rising rates, there's no equity risk premium. And literally, they just took and looked at when is the Fed raising rates, what's the equity risk premium, and when are they reducing rates, and what's the equity risk premium you get on the whole market. Well, on average, you get almost no equity risk premium while rates are rising. And when they're falling, you get all of it, which is not shocking. 1982 to today, we've had massive equity risk premium. Now we're starting to, is this going to be persistent, pervasive, term? Rates are going to rise forever, or are we going to get a Fed pivot? Is it going to be too dangerous for them to run the course they're running? And do they have to take rates back to 0 again?
You're going to have to be. This is all about time frames, right? Like what we're talking about is a decade, and within the 70s, there were bull markets and bear markets, right? As the Fed fought and lost,
and by the way, when you had returns, the Fed was easing, and when you didn't have returns, they were tightening.
No. This is I think short term. Could we see a Fed pivot as they see the economic numbers in a few months? For sure. Could there be a rally?
This
Maybe.
This particular factor is over the last 120 years. Just so we're clear, like this is a long-term feature of the markets.